Folks, welcome to the Contrarian Trader. This is Robert Desmond. Let's begin with a question that I'm asked quite frequently, and that question has to deal with my way of trading. And the question usually goes like this: Bob, the way you trade, isn't that more like looking in a crystal ball and trying to determine which way the market's going to go? To a certain extent, they're right. I'm looking at the chart, and I'm trying to look at patterns. What patterns am I seeing? Because when I see a pattern that sets up and is usually reliable, well, then it tells me that there's a probability, not an assurance, not a guarantee. There are no guarantees with the exception of one thing. You'll lose money in this market. That's the only guarantee. But when you're dealing with charts, you're looking at a probability of what will possibly happen in the market. Then you have your opposite side of looking at this market. And that's the Jim Cramer approach of bottoms-up fundamental analysis. You listen to the conference calls, and you listen to these managers, and you say, well, you know what? He sounds good. He sounds confident, and you believe it. And then you get the annual report and the quarterly report, and you open it up, you thumb through it, you read that thing, you highlight, you dog-ear pages. I don't do that. I look at charts. And the reason why I look at charts is because the charts don't lie. Even if there's a false indicator, like a false head and shoulders setup, at least I can put my stop loss order in for my partial position that I've opened, if I have, unless I was waiting for a break of the neckline. But at least I could stop out and know I was wrong. The charts tell me where to get out, and they tell me where to get in. But fundamental analysis doesn't do that. Now, taking case in point here, JP Morgan last week. Suppose I were to tell you that at the first week of April, the charts told you that you should not have been long of JP Morgan. I'm not saying that the charts were saying that it would have picked off the event last week that resulted in a big loss for JP Morgan. I'm not saying that. What I'm saying is this, is that, let's look at the chart. I have it up. This is a weekly chart of JP Morgan, and you can see back here. First off, you have the stock that broke through resistance. Then you can see right here, it was a weak breakout. You had a little bit of a topping tail. There's a little line above the body of the candlestick. Second week, the body got a little bit smaller, the topping tail got a little bit longer. And we were heading into resistance here with this other blue line. Is that a reason to sell? No. If I was a trader, I wouldn't be long. If I were an investor, I wouldn't be looking to buy. But if I was an investor, I bought in over here, and I'm thinking, JP Morgan, this is Jamie Diamon. I'm good here. I wouldn't necessarily be saying, let's sell, because I'm an investor. I'm thinking long term. I'm doing Warren Buffett stuff. Let's take a look at the volume. You could see that the volume during this time period here, during the breakout, was negligible. And it began dropping off. You can't have that on a breakout. And you can't have that when you're approaching huge resistance. Remember, this is the 2008 financial crisis here. We're approaching multi-year highs, pre-2008 highs. And you're going to do that? You're going to break out on declining of volume? I don't think so. That's not going to happen. And then you fast forward. Now, this is where the investors are wrong. They should be watching a weekly chart. But unfortunately, most investors don't watch the weekly chart. They don't look at charts at all, because you have guys like Cramer, who, although he does a segment every week on charts, he pisses on charts. Although he has them delivered it to his house every Saturday, he speaks poorly of charting. But why does he look at the charts? So you take a look here. You draw your trend line, take a simple crayon right here. Once this stock, JP Morgan, broke below this uptrend line here, you had to be out. And if you weren't out, you have only yourself to blame for being long of JP Morgan's last week. The charts were telling you the first week of April, get out of JP Morgan, get out of the banks. If you didn't do it, it's your own fault. And I really feel bad for investors. I do. If you're a trader and you did this, that's on you, man. You should have been using the trailing stop loss order, and you should have been out with a profit. I mean, you should have identified this double bottom here at 27.47, then at 27.90. You put in your low here, a higher low here. That was a buy signal. You put on a half a position, and then on this breakout above 37.03, you buy the rest of your position and you enjoy the ride up. Use your trailing stop loss order. If you're a trader and you didn't follow those rules and you took a loss last week, that's all on you. That's your fault. So let's get to who's to blame for JP Morgan's loss last week. Is it the government? Is it the company? Is it another rogue trader? Can you believe it's another rogue trader? I've been hearing about this since Barings Bank went down because of a rogue trader. I don't know how these guys get this much leverage to do this, but they do. Anyway, when you take a look at the structure, the economic structure of the United States right now, you have the Federal Reserve that is setting policy, not the Congress. You can't even get a budget out of the Congress for 3 years. You don't have a budget. So it's Ben Bernanke who's taking the heat, but he's the only guy steering the ship. So as much as I don't like the fact that interest rates are this low right now, and it's just bringing on inflation eventually, well, what are the other alternatives? You can't blame Ben. I'm sorry. You have to blame the politicians. Now, for JP Morgan to make money at interest rates at these levels, well, then they have to take on more risk. So I blame that on the policymakers. Ben Bernanke, the Federal Reserve, they're doing what they need to do because they don't have any policymakers in Congress that are willing to do anything. There is no leadership. All you have are professional politicians that are doing nothing. They're effing us day in, day out, screwing us. But does that let Jamie Diamon off the hook? By no effing means does it let him off the hook. Because Jamie Diamon said that this was a hedge. And a hedge to me, unless it's redefined in the world of Jamie Diamon, a hedge to me tells me that you were hedging because he was short. The hedge was a short of corporate bonds. That tells me that you were long of corporate bonds. So your long should have offset your hedging losses. Now, if you had 101% or higher short on the corporate bonds, well then, that's not a hedge, Jamie. I don't have an MBA from Harvard or Oxford or Wharton. That's not a hedge. That's a speculative play in the derivatives market. That's why you can't press a button and unload that trade overnight, because you messed around with derivatives. So that is all a bunch of BS. So I don't even want to hear that this was a hedge. That's a complete fallacy. Let's move on. Let's take a look really quick at the investability of the banks. Now, this is JP Morgan. This is on Yahoo. It's available to everybody. Key statistics. The beta on JP Morgan is 1.57 on a bank. On a bank who supposedly, up until this conference call, they don't take these kind of risks. That's how they survived the 2008 financial crash. The beta is 1.57. Now, you may say that's spiked up because of Friday's action. Well, let's take a look at a Goldman Sachs, 1.62. It's got a higher beta than JP Morgan's. Why do these banks, Goldman Sachs is a bank, why do these banks have such high betas? For those people that aren't familiar with the beta, a beta above 1 is a very risky, volatile stock. So I would argue that you shouldn't be making investments long term, in stocks with a beta above 1.5. And what are you getting paid? Less than 3% of a dividend on JP Morgan? You lost 3 years worth of dividends on Friday alone on a forward-looking basis. Now, my offer to Jamie Diamon is this. I'm going to offer you, because I'm a patriot, I'm going to offer you a free year to the Contrarian Trader, Jamie, because, again, I'm a patriot. And I'm going to tell you when you should buy back your stock, because you're in a buyback process and you've been buying it at high levels. So I'll keep you informed of when your stock bottoms. And Jim Cramer, this offer is open to you too, because maybe you can help your viewers. So Jamie and Jim, shoot me an email. I'll send you over a link to get a discounted price, free. You join in. I'll put you on the email list. You're in. That's my offer to Jim Cramer and Jamie Diamon. Call me a patriot. Let's move on to the stocks that we're watching this coming week. These are the stocks that I like. Cisco. Cisco reported bad earnings. Didn't Obama say that the economy was improving? I'm sorry. I digress. I'm sorry. Cisco reported bad earnings. It's getting hammered to hell. So this is on our watch list for next week. This is not a buy thus far, but I will be sending out an alert to members of when we look to get long of Cisco. Folks, I have so many stocks on my radar screen right now. It's huge for buys. I think we're going to get a rally in maybe not next week, the following week, but man, there's going to be a rally because whenever I see my screener get filled up with this much opportunity with big stocks like Cisco, Lexmark, not EMC, that's not a big stock. Fossil, that's Investors Business Daily Darling. Jeffries, Apollo Group. It's telling me that there's a near-term bottom in. Doesn't mean that the sell-off is over, the correction's over. It's just telling you that there's going to be an inevitable rally soon, and you need to get prepared for it. So Cisco is one of our watches. Lexmark, RSI at 1973, just barely makes it onto our screen. The 2850 level is resistance. I would not touch this stock here. It's going lower. So, folks, just so you know, if you're new to the Contrarian Trader, you just watch my videos for the first time, I send out another video to my members on Sunday, and I go into the weekly charts to determine the historical support on a stock and identify where a good opening position should be open, at what price. And we look at the short interest to see whether or not we have a catalyst to cause the stock to go higher. So I strongly suggest take advantage of the 14-day free trial offer. Sign up, you get it for free. If you don't like it, you cancel. Send me an email. So there's a couple of things that I don't like here on Lexmark. The stock is going to go lower. 50-day moving average has to cross over the 200-day moving average. I wouldn't touch this stock until that occurs. So please, just don't touch this stock. I don't want people losing money. Don't touch this stock. It looks oversold, and it is oversold. If you read technical analysis for dummies, they'll tell you you should have been long of this stock when it went below 20 on the RSI. Well, let's take a look. Where did it go below 20 on the RSI? Right about here. So even if you got in the late day here, you still went down from 30 to 28.45, wherever it closed. 28.30 is 31 was where it closed. I mean, technical analysis is not just using one indicator. You need to use historical support. You need to use RSI, your indicators. You need to use your candlesticks to determine, is the market starting to bid up the stock? Is the selling alleviating? You need to use your volume. You need to use your volume bars. You have to have it. You have to use all those in tandem. If you rely upon a stupid book, Technical Analysis for Dummies, and I hate to use that same example over and over again, it's only come to my mind. You can't use one indicator. It's so wrong that they do that. You need to use so many variables, it's ridiculous. So this stock, Lexmark, is under distribution, huge distribution. You stay away from it until it hits historical support. Members, I'll be going over that with you tomorrow. EDMC. This broke. It looked as if it was going to have support here at this candlestick. I don't know, this is about 10.50 thereabouts. Bottomed here a couple of times. Looked like it was going to hold. This told you, though, there was a possibility of a sell-off, so you needed to really think about getting out. It broke down Friday, and it's probably going to head down to its next logical support level. I'll be going over that with members tomorrow, and we'll look at that next support level using a weekly or monthly chart, wherever it shows. And if there is no historical support on some of these stocks, you need to take a look at, what's my guidepost here? There's no historical support. How do I know when to get into the stock? Well, you use your candlesticks and your volume bars. And that's what I teach my members, how to use those. Fossil, as I mentioned before, this is an IBD darling. Great fundamentals in the stock. I had a bad quarter. It's going to get hammered, probably still going to get hammered. When these momentum stocks, look at this momentum, get sold off, man, it's just an ugly picture. And it's a retailer. It's a very, very good company. But when these stocks go, they go hard. So I wouldn't go jumping in after this one. RSI at 1724. Your 50-day moving average is hooking down. You're probably going to see a short covering rally fairly soon in Fossil. I'll go over with members to decide whether or not we're going to make a trade here. I need to take a look at the intraday charts to see if there's a setup possible. So I'll go over that with members. I'm not sure right now, just looking at the daily chart. There's too many other things I need to do to make that determination. Jeffries, I have to do a little more due diligence on Jeffries. I don't know what happened here. But this is not a buy right now. Stay away from this stock. I mean, 19.52 on the RSI, and yes, you probably know now, RSI is big on my list of my indicators. It just barely makes it onto my screener. You could see on Friday that it couldn't even close back above its 200-day moving average. It's weak. It's going to get weaker. You need to take a look at historical support. So it's not interesting to me today. Maybe Monday, maybe Tuesday, we'll take a look at it. Apollo Group on a weekly basis. This is not a buy right now. Let's take a look at it on a daily basis. 18.96 on the RSI. I see one thing that's interesting about it, but that's about it. I think there's a good possibility that this stock heads lower. But we've traded Apollo before, so there's a good possibility that we may get involved with it again. Now, folks, you may wonder why you should join the Contrarian Trader. Well, and you may be asking, what's this guy's returns? What does he produce? Well, up until a few days ago, I was up about 25% on the year. However, I took a loss on two biotech stocks, ANTH and CRME, which brought me down to about 20%. I took a good size hit on those positions, but because I broke a rule. I normally don't trade pharma stocks, biotech stocks. And I broke a rule, so I lost a little bit of money. I'm not as up as I was, but I'm short this market. And how did I know to get short? When did my members know to get short of this market? So let's take a look at those charts. Okay, we knew to get short of the markets. What you're looking at right here is the IWM on a weekly basis. Similar to JP Morgan, I just showed it before. We broke down below this uptrend channel, and we knew that there was going to be an attempted rally to try to recapture this uptrend. But as soon as we saw this topping action here, we knew it was time to get short, which we did. We enjoyed the ride down. Markets rallied. We got short again. We took profits. Early last week, I reopened the position again on the TZA, using the TZA, which is a leveraged ETF, 3 times the move of the IWM. Very, very volatile. So if you're risk averse, you don't want to trade that. If you want to get short, short the IWM. So let's take a look at the daily chart. And I mentioned this last week on my YouTube video. I didn't put it on the blog. There's a reason for that. But I mentioned that there was a pattern setting up on the IWM. This is a daily chart. And that chart pattern was a head and shoulders formation. And you can see here, left shoulder, head, right shoulder. And it predicted that the markets are probably going to sell off this past week, which it did. However, they fought like the devil to prevent the IWM from closing below this neckline here, which you see in blue, because they knew what would happen. Technical sellers would come in, computerized trading, and they would dump the IWM, the Russell 2000. If the Russell 2000 goes, the entire stock market goes. So they knew they had to keep the IWM healthy. The banks were breaking down. What else? How do we know using charts again? How do we know using charts again that the markets were setting up for a sell-off? Well, you don't watch the futures. Everybody watches the futures. You wake up every morning and you see everybody on Squawk Box talking about, the futures are up, the bright green, it's all beautiful. Get the frig out of here. You should be watching the bond market. When the bonds are rallying, this is a weekly chart of the 10-year Treasury note. When the bonds are rallying, you stay away from stocks because money is flowing into the bond market. That's what I teach my members. You don't watch the futures. How many times have you woken up? The futures are up 100 points, 90 points, 60 points. By 10:30, they're red. What happened? Who pulled the rug out from underneath you? What game was played on you? That's all bullcrap. You need to watch the bond market. You also need to watch yields. Take a look at the yields on the 10-year bond. They're terrible. They're terrible. Not to mention that there's a divergence overlaid here in black. I've shown my members this for months. You need to watch for divergences. For months. Overlaid here in black is the overlay of the S&P 500. When you're looking at the 10-year yield, they usually trade in tandem together. However, that correlation broke. You had the S&P 500 heading higher through April, but the bond yields weren't rallying. At best, they were holding sideways. Now they're breaking down. So this is not good. And we knew it back here in April, March. I was saying it. So the charts are telling us long before this recent sell-off occurred, look out, get short. At least go to cash. And that's what we did. Commodities sector. Devastating nightmare. You shouldn't be long on commodities right now. Stay away. XLU. Why do I bring this up? XLU is our proxy for interest rates. Why? The XLU is an ETF of the Utilities Select Spider. You want to buy the utilities, you know which one to buy, you buy the XLU. I watch it, though, because the XLU competes with treasuries because they always have to offer a little bit more interest on their bonds because, remember, utilities are always maintaining their facilities, they're building out their facilities. They're very capital intensive. They have to float bonds and debt, huge amounts of debt. So when treasuries are low, it's great for the utilities. That's why you're seeing such a great market. They're rallying higher, even though the market was really selling off last week. Yeah, the PPI that came in weak last week, that should have been good for the utilities, but aha. Somebody shoot me an email if they see what's wrong with the utilities here. On this chart, take a look at your volume bars, take a look at your candlesticks, shoot me an email. What's wrong with this chart? PPI, Producer Price Index, is a measure of the cost of producing goods. Went down. That means that should tell you that there's not going to be any inflation passed along to consumer, right? That means the CPI should come out low as well. Then why is it the XLU is topping off? Question mark. Divergence, contrarian way of thinking. That's it, folks. I'm not going to go into the rest of these charts right now. Members, I'll be sending out the week ahead commentary tomorrow. You'll expect it. I'll get it out to you as soon as possible. I'll be working on it for the remainder of the day today. Folks, please take advantage of the 14-day free trial offer, and you'll get the week ahead commentary. And I will talk to you soon. Have a great, great trading week. Take care, folks. Bye-bye.